Hi, my name's Scott Dahl. Thank you for tuning into another one of my podcasts. Today, what I want to do is I want to discuss price gaps. We're experiencing price gaps in this up move, and they're extremely significant from a technical perspective. First thing I want to do is give you a little bit of a recap. So if you look up at the screen right now, what I have is the Dow Jones Industrial Average. Now, what I said in the previous podcast, but the most recent podcast about a month ago, is that I believe that this was nothing more than a garden variety correction. And the reason I believe that is because the fear was injected relatively quickly. Everybody was scared to death. And it's going to be scary on these sell-offs, on these corrections. Ordinarily, during a midterm election year, we have a correction of about 17%. So I suggested, if you look at this Dow Jones, that industrial average, we could go down to here, or possibly even down to this level. You just don't know. But I also said that this is a significant area of support right here on this first dashed line. The reason for that is twofold. Number one is it's a Fibonacci retracement. All three of these are, but this is the first one. And the first one I thought would hold because these tops, you see this top here, and this top here, this area, these three tops, once we broke out of that, that turned into significant support. So we had the first Fibonacci retracement, 38% back from the highs, and we had these three tops that would act as significant support. So we bounced off here, and we bounced off here handedly. So what I'm going to do is I'm going to explain price gaps and what they mean to us as investors. They're very significant. A gap is a space where there's no trading. And if you look at this market, this is the NASDAQ market. I've blown it up. This is kind of right around in the start of the year right here. So this is a year's worth of data. Every one of these is a day. A green is an up day, a red is a down day. This is a significant price gap. See all this area right here where it didn't trade? That signifies a change in trend. So that signifies it returned. That also is an incredibly strong support area. A gap typically fills itself in 3 days, 3 weeks, and 3 months. Well, we've gone 5 price days. We have not filled that gap. So that gap, in all likelihood, will hold for a while. Also, here's the 200-day moving average. Here's the 50-day moving average. Those are very important. You want the 50-day above the 200 in the trend, and you want them to go higher. So they're starting to turn. And most importantly, this gap, this enormous price gap, it went up above both of these moving averages. So I'm seeing significant strength here. There are 3 types of gaps. There's a breakaway gap, there's a runaway gap, or also they call it a measuring gap. And then there's an exhaustion gap, which is kind of at the end of the trend. This is the breakaway gap here. It's held. We're still trading today. It's 10:47 Pacific time on April 14th. But if this gap holds for another 2 days, that's what's called a measuring gap. We're currently trading in the NASDAQ composite at 23,610. This measuring gap gives us a target of 25,927. So that's new highs. That's up in this area right here. Is this going to happen? I don't know. Who does, right? Who can predict the future? But these are the odds of probability from what I've seen. So if this gap holds for a couple more days, I think we're going to make it to new highs. Another thing about a gap, so we have the breakaway gap, we have the measuring gap, or the runaway gap here, and then we should move higher, and then we should see a third gap. But with the caveat that gaps are like magnets. So this price gap, it's wanting to suck this market back down in, but typically when it does, it will fill it, trade sideways, and then it has a tendency to move in the direction of the previous trend. So what I'm saying to you right now is I see an uptrend here. I see potential for new highs. Anything could happen. It's a very tenuous situation, but this market looks good to me. Where else do we have a price gap? This is the daily chart of the Standard & Poor's 500. We went down through this 200-day moving average. That's not good, but the market can go down through the 200-day. It has in the past, it can go down through it. If it stays below it for a significant period of time, you've got a bear market. But the fact it popped back up above it, that's a real good sign. That's a good sign that we flushed out the speculative excess out of the market. So we have a structure to move this cyclical bull market higher. And what did we do here? Again, this is the S&P 500. I'm going to blow it up. What we did here is we had a significant price gap. We held it for 4 days, and then we've got another gap. So you can see that this is the top of yesterday, and here's the bottom of today. If this holds for another couple days, this would give us a price target in the S&P 500 is 7,500, which is up in this area here. Now, I'm not predicting what's going to happen. All I'm telling you is I try to develop the probabilities, because when you manage people's money, first of all, you want to manage it from a holistic perspective. You want to look at the risk. I mean, it's different for each and every client, but you have to have an idea of what the market is going to do or what the trend's going to do in order to position people properly. And that's what I try to do with the technical analysis. So let's take a look at breadth. I've heard that breadth is really bad, but if you look at the breadth of the New York Stock Exchange, which is typically what I use to measure the strength of the trend, you can see that it did indeed come down. It tested its 200-day moving average, and now it's moving significantly higher at the market. So I just don't understand the bearishness on this drop. I like it because it gave us this opportunity to buy, and I think it settled the market in. So not only do I not understand the bearishness, I don't understand why everybody's saying that breadth is so horribly bad. There's a lot of different measures of breadth, but it looks positive to me as well. So what I believe is we're in a cyclical bull market, in a secular bear market. I think we've had a significant recovery here. Anything could happen because we've got the volatility from the war. However, it looks like to me from a trend standpoint that we're going to continue to move higher. If you have any questions, give me a call at 949-497-6366. It's Scott@DowellCapitalAdvisors.com. So we'll see what progresses, and I'll come out again when I feel like there's something significant that I need to identify. Give me a call if you have any questions, and thank you for watching.